Let me tell you something that the financial industry will never say out loud. Investing is genuinely hard, not because the math is complicated, not because markets are unpredictable. Those things are true, but they're not why most people struggle. Most people struggle with investing because the entire system, the education system, the media, the financial products industry, and even their own brain chemistry is working against them in ways they don't fully understand. In 2026, the TIAA Institute ran the 10th year of its annual financial literacy test. Americans correctly answered only 47% of the questions, less than half. Not on advanced topics, on basics, and that score is the lowest it has been in the entire 10-year history of the survey. 1 in 4 Americans now falls into the category of very low financial literacy. That number has been growing steadily for a decade, despite the fact that free financial information has never been more available in human history. Something is making investing hard that has nothing to do with access to information. And today, I want to tell you exactly what it is. Reason 1. Your brain was built for survival, not for markets. In the 1970s, 2 psychologists named Daniel Kahneman and Amos Tversky ran experiments that would eventually win a Nobel Prize. What they discovered is called loss aversion, and it is the most important and most ignored concept in personal finance. Loss aversion means that the pain of losing something is roughly twice as powerful as the pleasure of gaining the same thing. Like, losing $1,000 feels approximately twice as bad as gaining $1,000 feels good. Think about what that means when you apply it to investing. The stock market moves up and down every single day. The average daily swing is about 1% in either direction, which means that when you check your portfolio and it's down 1%, you feel about twice as bad as you feel good on the days it's up 1%. The emotional math of investing is negative even during periods of strong average returns, and when that negative emotion gets intense enough, the brain does what it evolved to do. It triggers the response that kept your ancestors alive: fight or flight. The problem is that fight or flight was designed to protect you from lions, not to help you make rational long-term decisions about your retirement account. When that response fires, you're not thinking about 30-year compound returns. You're thinking about making the pain stop right now. And for most investors, the way you make the pain stop is by selling. Here's what selling during a downturn actually costs. Morgan Stanley tracked investors from 1980 through 2025. An investor who stayed fully invested the entire time achieved roughly a 12% annual return. An investor who sold after downturns and waited for 2 consecutive positive years before reinvesting averaged around 10%. Same starting point, same time period, but the stay invested investor ended up with $6.1 million, while the sell and wait investor ended up with $3.6 million, a $2.5 million difference, not from different investments, from different emotional reactions to the same investments. Your brain is not your enemy, but in the context of long-term investing, it is not naturally your ally either. And no one tells you that when you open your first brokerage account. Reason 2, the education system never gave you the foundation. Here's a question. How many years of school did you complete before entering the workforce? 12, possibly 16 or more. And in all of those years, how much structured, unbiased education did you receive about how to invest money? For most people, the answer is close to 0. You may have learned what a stock is in a passing economics lesson. You may have done a simulation where you tracked a pretend portfolio for a semester. But the foundational concepts that actually matter for building wealth over time, how compound interest works, what diversification actually means versus what people think it means, how to evaluate investment risk relative to your own timeline, the difference between investing and speculating, almost none of that was taught in any systematic way. And the consequences of that absence are measurable. According to the Junior Achievement and Ipsos survey from March 2026, 23% of Americans say They believe their income could be sufficient if they just understood how to manage it more effectively. They have the money, they don't have the framework. And without a framework, people do the thing that feels safest even when it's not. They keep everything in cash. They avoid markets entirely because markets feel unpredictable. They defer the decision indefinitely because the complexity feels like too much. In 2024, total assets sitting in cash investments in the United States hit $18.9 trillion, $19 trillion sitting in money market accounts and savings accounts, while inflation quietly eroded its real value every month. Not because those investors were irrational, because they didn't have enough knowledge to feel confident doing anything else, and no one built that knowledge for them. Reason 3. The noise is designed to confuse you. Here is a number that tells you almost everything you need to know about modern investing culture. 1 in 2 American investors check their portfolio at least once per day, every morning, just to see what happened. And the reason this is a problem is not that staying informed is bad. The reason is what checking every day actually does to your decision making, because every time you check and the market is down, which given normal market volatility happens roughly half the time, your loss aversion gets triggered. And the more often your loss aversion gets triggered, the more likely you eventually are to react to it. In 2026, 18% of American investors admitted to making a panic-driven investment decision as a direct result of doom scrolling, reading negative financial coverage for long enough that anxiety overrode their judgment. Among millennials, that number was 21%. Among Gen Z, it was 23%. Nearly 1 in 4 younger investors has made a financially damaging decision because they read too much bad news. This is not a coincidence. Financial media is not structured to help you build long-term wealth. It's structured to keep you reading, and the most reliable way to keep people reading is to make them feel that something important might change if they stop paying attention. The answer for most long-term investors on most days is stay the course. This doesn't require a response. But that answer doesn't generate traffic, so it doesn't get written. The result is a permanent stream of coverage optimized to trigger the exact psychological state, anxiety, urgency, fear, that causes investors to make their worst decisions. And most people consuming that coverage have no framework for distinguishing between the signals worth responding to and the noise that should be ignored entirely. Reason 4. The industry profits from your confusion. Let me say something directly. The financial services industry has a structural incentive to keep investing complicated. The more confusing it feels, the more likely you are to pay someone to manage it for you. The more uncertain you are, the more attractive active funds with high fee ratios look compared to low-cost index funds that require no manager at all. The more overwhelmed you feel, the easier it is to sell you products with layered fees and complex structures that benefit the seller far more than the buyer. This is not a conspiracy. It's just how incentives work. And over decades, those incentives have shaped what gets explained clearly and what doesn't. Here is what the academic research consistently shows. Over a 10-year period, roughly 80 to 90% of actively managed funds underperform a simple, low-cost index fund tracking the same market. The managers being paid to beat the market on average don't beat the market, and the fees they charge for not beating it, typically 1 to 2% per year, compound into enormous sums over time. A 1% annual fee on a $200,000 portfolio over 30 years costs you approximately $200,000 in lost compound growth for underperformance. The simplest, best documented investing strategy for most people, regular contributions to a low-cost, diversified index fund held for decades, is also the strategy that generates the least revenue for the financial services industry, which is why it's rarely the thing that gets marketed most aggressively to you. You have to find it yourself. Reason 5. The starting line feels impossible. The final reason investing is hard for most people is the one that doesn't get enough credit. It's not psychology, it's not ignorance, it's the feeling that there's nothing left over to invest in the first place. The average American now carries $6,600 in credit card debt at over 20% interest. The average new car payment hit a record $770 a month in the first quarter of 2026. Inflation is at 4.2%. Real wages are negative for the second consecutive month in 2026, and the personal savings rate has dropped to 2.6%. For a growing number of households, the math just doesn't produce a surplus. And without a surplus, investing feels like a conversation that belongs to someone else. I want to be honest with you about this one. For some people, the starting line genuinely is harder than it is for others. That's real, and it's worth saying. But for many people, not all, but many, there is more room than they realize. Not because they're irresponsible, but because no one has ever shown them where to look. Automating a small contribution first, claiming an employer match that's currently being left on the table, redirecting what goes to interest on high-rate debt before adding new debt. These are not dramatic strategies, but for someone who has never had a framework for where their money goes, they can be the difference between starting and not starting. And starting matters more than almost anything else because investing rewards time above everything. The investor who starts with $50 a month at 30 and never increases it will outperform the investor who starts with $500 a month at 45. That's not a motivational statement. That's compound interest math. Here is where I land. Investing is hard for most people for 5 very specific reasons. The human brain is wired to react to short-term pain in ways that destroy long-term returns. The education system never built the foundational knowledge required to feel confident. The media is optimized to generate anxiety, not clarity. The financial industry profits from confusion more than from simplicity. And for a growing number of households, the margin to start feels impossibly thin. None of those 5 things are your fault. But understanding them is the first step toward not being controlled by them. Which of these 5 hit closest to your experience? Was it the emotional reaction, the knowledge gap, the noise, the industry, or just the feeling that there's nothing left over to invest? Drop it in the comments because I think the honest answers to that question matter more than most of the content that gets made about investing.